This is The Millionaire Next Door, Chapter 2, pages 74 through 80. The ultimate consumption category. The typical millionaire in our surveys has a total annual realized income of less than 7% of his wealth. This means that less than 7% of his wealth is subject to some form of income tax. In our latest study of millionaires, the percentage was found to be 6.7%. Millionaires know that the more they spend, the more income they must realize. The more they realize, the more they must allocate for income taxes. So millionaires and those who will likely become affluent in the future adhere to an important rule. To build wealth, minimize your realized or taxable income and maximize your unrealized wealth/capital appreciation without a cash flow. Income tax is the single largest annual expenditure for most households. It is tax on income, not on wealth, and not on the appreciation of wealth. This appreciation is not realized. That is, if it does not generate a cash flow. What is the message? Even many high-income producing households are asset poor. One reason is that they maximize their realized incomes, often to support high consumption lifestyles. Such people might wish to ask themselves a simple question: could I live on the equivalent of 6.7% of my wealth? It takes much discipline to become affluent. We have interviewed many people worth 2 or 3 million who have a total realized annual household incomes of less than 80,000. How much does a typical American household realize in income each year? About 35,000 to 40,000, or nearly the equivalent of 90% of its net worth. The result is that the typical household in America pays the equivalent of more than 10% of its wealth in income taxes each year. How about the millionaires whom we surveyed? On average, their annual income tax bill is an amount equal to only a bit over 2% of their wealth. That is one of the reasons they remain financially independent. Case study: Sharon and Barbara. Sharon is a high-income producing healthcare specialist. She recently asked us, "How is it that I make so much in terms of income, but accumulate so little in terms of wealth?" Last year, Sharon's household had a realized total annual income of approximately $220,000, which places her household in the top 1% of all households in America. Sharon's household has a net worth of approximately $370,000. While Sharon's income is higher than 99% of other households in America, her net worth is far below what it should be, given her age, 51, and her income, $220,000. Sharon should, according to the wealth equation, expected net worth equals 1/10 age times income, be worth approximately $1,122,000. Why is Sharon's level of accumulated wealth far below the norm? Because her realized or taxable income is too high. Last year she paid $69,440 in federal tax on her $220,000 income. This is the equivalent of 18.8% of her total wealth. Yogi Berra might say, "Sharon, you can't be wealthy. Your income is too high." Table 2-3, Contrast among American taxpayers. We believe that the average person in Sharon's income/age category pays the equivalent of only 6.2% of his wealth in annual federal tax, or $69,440 divided by 1,100,022. Thus, Sharon's tax equivalent, 18.8% of her wealth, is 3 times higher than the tax equivalent for the average person in her income/age category. To view this another way, Sharon has an annual realized income that is the equivalent to 59.5% of her total net worth of $370,000. How could anyone hope to become truly wealthy when the equivalent of nearly 60% of her wealth is subject to income tax each year? The average person in Sharon's income/age category realizes the equivalent of only 19.6% of his net worth in annual income. Thus, only about $1 in $5 of his net worth is subject to income tax. What about people who have above average levels of wealth? How much of their equivalent net worth is being taxed? Barbara is a typical member of the PAW category. Her realized annual income is approximately the same as Sharon's, $220,000, but Barbara's net worth is approximately $3,550,000. Therefore, the equivalent of only 6.2% of her wealth is subject to federal income tax. What percentage of Barbara's wealth is paid in federal income tax? Approximately 2%. In sharp contrast, Sharon paid the equivalent of 18.8% of her wealth in federal income tax, or more than 9 times the percentage for Barbara. The average American millionaire realizes significantly less than 10% of his net worth in annual income. In spite of having considerable wealth and substantial annual increases in wealth in unrealized form, the typical American millionaire may personally be cash poor. More than 20% of Barbara's annual realized income is invested in financial assets that tend to appreciate in value without generating realized income. Sharon, on the other hand, invests less than 3% of her realized income. Most of her financial assets are in liquid form. Sharon's economic situation is quite risky. She is the main breadwinner in her household, which has little investment income. If her employer eliminates her job, what then? There are not too many positions available today that pay $200,000 or more a year. Barbara, again, in contrast to Sharon, has a business with more than 1,600 customers. That's 1,600 sources of income. This is much less risky than Sharon's position. Sharon could not survive for 6 months if she lost her source of income, but Barbara could easily survive for 20 or more years. Actually, she could retire at this point on the income from her financial assets alone. Barbara, the prodigious accumulator of wealth, is just one of more than 3.5 million Americans in America today. 3.5 million millionaires in America today. More than 90% have a net worth between 1 and 10 million. How do these affluent people compare with the super affluent? Indicators are that the higher one's net worth, the better one is at minimizing one's realized income. The fact is that the super affluent got to that position by being masters at minimizing their realized income. Ross Perot is the perfect example of how the super affluent stay affluent and even enhance their levels of wealth year after year. Forbes recently estimated that Mr. Perot's net worth was $2.4 billion. The Citizens for Tax Justice, a tax reform group headquartered in Washington, D.C., estimated that Perot's annual realized income in 1995 was approximately $230 million. Thus, he realized the equivalent of 9.6% of his wealth, but only paid $19.5 million in tax, or 8.5% of his income. Compare this figure with the 31.6% of their income paid in tax by Barbara, Sharon, and many others in their income category. How does Mr. Perot end up paying such a small percentage of his income in tax? According to a recent newspaper report, Perot minimizes his tax bill by investing heavily in tax-free municipals, tax-sheltered real estate, and stocks with unrealized gains. Of particular interest, Perot's tax rate has a percentage of his income that is 8.5% is lower than that of the average American household. The average American household in this country pays $4,248 in federal income tax each year, or the equivalent of 12.9% of their annual realized income of $32,823. Perot is super affluent in terms of accumulated wealth, but he has less than the common man's marginal tax liability. Even more interesting than the percentage of income paid in taxes is the percentage of wealth paid in taxes. The typical American household has a total net worth, including equity in the home, of $36,623. They pay the equivalent of 11.6% of their net worth in income tax. What about Mr. Perot, the billionaire? In 1 year, is it estimated he paid the equivalent of only 0.8% of his wealth in tax? In terms of income tax paid as a percentage of wealth, the typical household paid 14 and a half times more. Most millionaires measure their success by their net worth, not by their realized income. For the purposes of wealth building, income doesn't matter that much. Once you're in a high income bracket, say 100,000 or 200,000 or more, it matters less how much you make. It matters less how much more you make than what you do with what you already have. Working for the tax man. Assume for a few moments that you are Mr. Bob Stern, a scholar who works for the IRS. One morning, your manager, Mr. John Young, calls you into his office. He gives you an assignment to enhance his understanding of the relationship between income and wealth. Mr. Young: Bob, I keep reading reports about the growth of the millionaire population. Mr. Stern: Yes, I have a pile of articles and clippings on the same topic in my desk. Mr. Young: Well, here's the problem. The number of wealthy people keeps rapidly increasing, but our income tax revenue for a lot of these people is not keeping pace. Mr. Stern: I read somewhere that the wealthiest 3.5% of the households in this country account for more than half of the personal wealth, but these same folks account for less than 30% of the income. Mr. Young: I wish Congress would wake up. What this country needs is a tax on wealth. Even in biblical times, the rich had to pay 10% of their wealth each year in taxes. Now that's what I call the ultimate tax reform. Mr. Stern: I know what you mean, but sooner or later, we will get 'em. Remember, it's inevitable. Death and taxes. Mr. Young: The estate tax area is not spittily, Bob. You are a little naive on this issue. You are thinking that we will eventually take a big bite out of all the millionaires in this country by taxing their estates. Mr. Stern: The Grim Reaper is on our side. Mr. Young: Not so fast, Bob. Just think of all the millionaires in this country. Most of them own some kind of business, and a whole bunch own stocks. What do these folks do with their money? They sit on it, or they plow it back into their business. They hold on to all those stocks that keep appreciating. Mr. Stern: But what about the Grim Reaper? Mr. Young: Look at it this way, Bob. We have often looked at estate returns in the 1 million and above level. Last year they were only about 25,000. But, Bob, at the same time, there were 3.5 million Americans alive and kicking. That means that 0.7% were picked up by the Reaper. This number should be twice as high. But you know what a lot of millionaires do? Before the Reaper shows up, they transform themselves. It's like magic. Mr. Stern, how do they do it? They can't just vanish. Do they move offshore before the Reaper shows up? Mr. Young: Offshore is not a significant factor, but I would not be surprised if we found that half of the millionaires transform themselves into non-millionaires, BR. What do you mean by BR? Mr. Young: It's an insider term. BR means before the Reaper, or prior to death, as opposed to AR, or after the Reaper. Look at this case study. Here's a woman, Lucy L., who had $7 million just a year before she died. She lived on her pension money, never in her life sold a share of stock out of her portfolio. Her wealth doubled in just the 6 years between her 17th and 76th birthdays. But what did we get out of it? In terms of income tax, nearly zip. She essentially had no realized income from her portfolio. I hate unrealized income.